Assalamualaikum to our respected lecturer, Madam Masniza. I'm Iman Baki Shukri, and with my group members today, we'll be presenting about Chapter 26, which is Internal and Governmental Financial Auditing and Operational Auditing. So let's begin with internal financial auditing. So what is actually internal auditing? Internal auditing is an independent and objective function within an organization that provides assurance and advice. Its main role is to help improve how an organization operates, especially in areas like risk management, internal control, and corporate governance. So, internal auditing is a systematic and disciplined approach that evaluates and improves how well risks are managed and controls are working. And it's not just about checking numbers, but it's also improving the whole system. So, for example, internal auditors might check if financial reports are accurate, employees follow company policies, and risks like fraud or data breaches are being managed. So, by doing this, internal auditors help protect the organization's resources and reputation while supporting decision making at all levels. So, the Institute of Internal Auditors Malaysia, IIAM, is the main body that supports and regulates internal auditors in Malaysia. It aligns with the global standards set by IIA Global. So, let's take a look at two key components of their guidance. So, the first one is from Institute of Internal Auditors Ethical Principles and Code of Ethics. So, IIAM expects all internal auditors to follow these four core principles, which is the first one is integrity, that auditors must be honest and trustworthy, and their actions should build trust with stakeholders. Second is objectivity, that the auditors must remain unbiased and avoid situations that could influence their decisions. Third one is confidentiality, that they are trusted with sensitive information and must not disclose it unless legally or professionally required. And the last one is competency, that the auditors must have the necessary knowledge, skills, and experience to do their job effectively. So these values are crucial to maintain professionalism and credibility. So the second one is professional practices standards, that IIA provides a structured framework called the International Professional Practices Framework. This includes two standards, which is attribute standards that relates to the people performing audits, such as independence, proficiency, and due professional care. And the second one is performance standards that focus on how audits should be conducted, such as planning, communication of results, and monitoring progress. So following these standards ensures consistency and quality in internal audit activities. So the next part is, when can external auditors use their work? So ISA 610 is an international auditing standard issued by the International Auditing and Assurance Standards Board that provides guidelines to external auditors on when and how they can use the work performed by the internal audit function. So before relying on this work, the external auditor must assess three main areas. First, objectivity of the internal audit function. So whether the internal auditor is free from influence, does their position in the company allow them to work independently, and do company policies and reporting lines supporting their independence? Second is level of competence. So does the internal auditors have the right qualifications, training, and experience? And also, is their work regularly reviewed and updated? And the third one is systematic and disciplined approach. So does the internal audit function follow clear methods and standards? Are their procedures well documented, or do they apply internal quality control? So if all these areas meet the required standard, the external auditor can use some of the internal auditor's work to reduce duplication and focus on higher risk areas. However, ISA 610 also clearly states when external auditors should not use the work of internal auditors. So this apply when any of the following weaknesses are found. The first one is lack of objectivity, whether the internal auditors are influenced by management or they don't report independently, so that their work can't be trusted. The second one is insufficient competence. The internal auditors don't have proper qualifications, or their work lacks accuracy and depth, and it's not reliable. So the third one is weak methodology or no quality controls, that if the internal audit function doesn't follow a structured professional process or lacks quality review, their work also isn't dependable. So in these cases, the external auditor must perform all audit procedures independently to ensure the accuracy and fairness of the financial statements, that these protects stakeholders and upholds the reliability of the audit report.
Hi everyone, I am Ira Aina. Now I will begin by discussing the key standards and roles of internal and external auditors. Internal and external auditors play distinct but complementary roles in an organization's audit ecosystem. Internal auditors are responsible to management and are focused on evaluating and improving the effectiveness of internal controls, risk management, and governance processes. They must demonstrate competency, apply sound methodology, remain objective, and use the audit risk model and materiality to guide their evaluations. External auditors, on the other hand, are responsible to users of financial statements, such as shareholders and regulators. Their role is to provide assurance on the credibility of financial reporting. Despite their different accountabilities, both internal and external auditors use similar auditing methods, adhere to professional standards, and are expected to maintain a high degree of objectivity and professional competence in performing their duties. External auditors rely on internal auditors when using the audit risk model to assess control risk. If internal auditors are effective, the external auditors can significantly reduce control risk and thereby reduce substantive testing. As a result, external auditors may reduce their fees substantially when the client has a highly regarded internal audit function. External auditors typically consider internal auditors effective if they are independent of the operating units being evaluated, competent and well-trained, and have performed relevant audit tests of the internal controls and financial statements. Auditing standards permit the external auditors to use the internal auditor for direct assistance on the audit. By relying on the internal audit staff for performing some of the audit testing, external auditors may be able to complete the audit in less time and at a lower fees. When internal auditors provide direct assistance, the external auditors should assess their competence and objectivity and supervise and evaluate their work. Directors of public listed companies have specific responsibilities when it comes to disclosing the state of their company's internal controls. To support this, guidelines have been developed drawing from the UK's Turnbull Report of 1999 to assist directors in preparing these statements for inclusion in their annual reports. These guidelines emphasize the importance of true risk assessment and require directors to evaluate both the adequacy and integrity of internal control systems. Additionally, directors are expected to consider risks specific to the nature of their businesses and make independent judgments regarding the effectiveness of controls. The aim is to ensure that disclosures are transparent, accurate, and reflective of the true internal environment of the company. In the context of governmental auditing, the Jabatan Audit Negara in Malaysia serves as both an internal and external audit body for public sector organizations. Government audits are conducted based on an authoritative audit manual issued by the JAN. This manual provides guidance on auditing a range of areas including financial statements of governmental units, compliance with government contracts and grants, evaluation of internal controls, detection of fraud, and adherence to relevant laws and regulations. These audits play a critical role in ensuring that public resources are used efficiently, effectively, and in compliance with legal frameworks, thereby promoting accountability and transparency in the public sector. Under the Audit Act 1957 and guided by the Malaysian Federal Constitution, Article 97, the Auditor General is mandated to audit the accounts for the Federation, the states, public authorities, and other bodies receiving public funds. This includes funds established by either the federal or state government, as well as corporate bodies that receive loans or grants. The audits are carried out using the audit manual and are designed to ensure that government expenditures and financial practices comply with legal requirements. By performing these audits, the Auditor General helps uphold the integrity of public financial management and ensures that taxpayer money is properly accounted for.
Assalamualaikum and hi, my name is Amalia Sofia binti Azim and I will be presenting about the audit and reporting requirements, specifically focusing on the audit manual. The audit manual provides formal guidelines to help the auditors on how to do audit properly, what rules and standards they need to follow, and also how to promote accountability and transparency. This will ensure that the auditors carry out responsibility according to the Federal Constitution and also the Audit Act 1957. The auditors need to follow 5 standard bases, which are Audit Act 1957, TAN's practices and experiences, standard used by accounting professions, International Organization of Supreme Audit Institution, and the last one is other Supreme Audit institutions such as ASOSAI. This manual is important because it gives clear rules so that the audits are done professionally and consistently. Next is financial auditing standard, which guide the auditors in performing reliable audits. The first standard is materiality, which the auditors need to focus on information that is significant enough to affect decision making. The small errors can be ignored if they don't make a huge difference. For example, if 5 ringgit is missing from a 1 million budget, it is not a major issue. Otherwise, if 100,000 is missing, that is considered material and must be reported. Next is audit quality control, which this will ensure that every audit is done properly and follows professional procedures. It includes things like supervision, review, and also proper planning. For instance, after a junior auditor finishes their part of the audit, a senior auditor will check and review the work to make sure it meets the required standard. The third one is compliance with laws and regulations. This means that the auditors need to check if the audited organization is following the law and government policies. For example, if a department awards a project without going through the required tender process, this goes against procurement rules and must be reported. The fourth is audit evidence and documentation. The auditors need to collect strong and reliable proof to support their findings, which includes the document like invoice, payment slips, and also the emails. For instance, if the auditors find that a supplier was paid twice, they will keep the invoice and both payment received in the audit file as proof. Last but not least, the proper audit reporting, which is the after the audit is complete, the report must be clear, complete, and easy to understand. It should explain what was found, what it matters, and suggest the improvement. For example, 200,000 was spent without approval. The report should clearly state what happened and recommend how to prevent it in the future. Moving to the next part, which is reporting requirement under the Audit Act 1957. The auditors need to report when there are financial issues found in the public sector. First, when essential accounts or records are not properly maintained. For example, a school received 100,000 in government funding, but during the audit, there was no receipt to show how the money was spent. This lack of documentation raises concern about possible misuse or poor financial management. Second, when money is not fully accounted for. For example, government clinic that received 50,000 to buy medical supplies, but only 40,000 is supported with receipt. The remaining 10,000 is missing without explanation. Third, if funds are used for something that was not approved. For instance, a department received 20,000 to build toilets in rural areas, but instead used the money to buy new furniture. Even though the furniture may be useful, it is not the approved purpose. Fourth, money spent against laws or policy is another reporting requirement. For instance, a ministry awarded a million contract without following the open tender process, which goes against government procurement rules. This is against the procurement policy and must be disclosed in the audit report, even if the project is legitimate. Fifth, weak internal control must also be reported. For instance, government storehouse that keep tools and equipment has no inventory list and many items have gone missing. This shows a lack of control that could lead to losses. Lastly, any spending without proper approval is also reportable. For instance, an officer used 70,000 from government funds for an overseas trip without getting approval from the ministry, even though it was required. Other than that, there are three key responsibilities that the auditors must check. First, the auditors must check if government vehicles, equipment, and stocks are recorded and protected. If laptops or supplies go missing and there is no proper tracking system, that must be reported. Second, the auditors need to check if all government's income like taxes, fees or fines is correctly collected and recorded. If money is missing or goes into the wrong account, it is need to report it under the Audit Act. Last but not least, the auditor needs to check that all expenses are authorized. For example, if someone spends public money without permission or on the wrong thing, that is a violation and it must be included in the audit report. Last but not least, the auditor needs to follow the general guidance that already stated for the auditors in order to do their job well. First, they need a good understanding of the Federal Constitution and other basic laws, which this will help them in identify when something is going wrong or illegal. Second, the auditors need to understand the Audit Act 1957 as well as all the relevant audit concepts and standards. This will ensure them the tools to conduct a proper audit and report their findings effectively. With these two guidance, the auditors can perform their duties with professionalism and also integrity.
Assalamualaikum and hi, my name is Nora Chikin and I will explain purpose of operational auditing. First of all, what is operational auditing? Operational auditing is a type of internal audit that focuses on how well an organization runs, not just in terms of money, but in overall performance. The main purpose of operational auditing is to determine the effectiveness and efficiency of any part of an organization. So why is this important? Operational audits helps identify problems that may slow down performance. They provide recommendations for improvements so that the organization can save money, save time, and work better. Most importantly, the goal is to help improve future performance, not just check past mistakes. Now I will explain about the differentiate between operational and financial auditing. So we can differentiate it by the purpose of the audit, distribution of the reports, and inclusion of non-financial areas. Now, let's start with the purpose of the audit. So on the left is operational auditing and on the right is financial auditing. So firstly is on the emphasis for operational auditing. It emphasizes the efficiency, which means how well resources like people, time or money are being used, and effectiveness of an organization, whether the organization is achieving its objective. While for financial auditing, it emphasizes whether historical information was correctly recorded, whether the financial statements are accurate, complete, and compliant with accounting standards. Next is about what is the focus. For the operational auditing, it is focuses on improving future performance, while financial auditing, it is oriented to the past. For the next difference is about risk management. So operational auditing identifies operational risks and controls, while financial auditing is about detecting financial fraud, misstatements, or irregularities. Moving on to the next one is about value addition. Operational auditing adds value through process optimization and risk mitigation, while financial auditing provides assurance to stakeholders about financial data. Last but not least, the objective for operational auditing assessing operational performance and controls, while for financial auditing ensuring compliance with accounting standards and regulations. The next difference is distribution of the reports. Firstly is about who is the audience. For operational auditing, the reports are intended primarily for management only, like managers or department heads. And for financial auditing, they are typically distributed to external users of financial statements, such as shareholders, bank, investors, creditors, and others. Next, who perform the audit? The auditors performing operational audits are employees or the company, and since it is done internally, the management has control over it. But for financial auditing, it is done by professionals, which are external auditors that are not controlled by the management. Also, for the format, in operational auditing, it does not have a standard format, while for financial auditing, it has a standard format like audit opinion or financial statement notes. Next, who has access to the audit reports? For operational auditing, the reports don't need to be published or shared with the public, but only the management has access to it. But for financial auditing, it must be published publicly. So last but not least, how frequently does it need to be done? Operational auditing can be done periodically as needed often throughout the year, and for financial auditing, it is typically done annually or sometimes semi-annual or quarterly depending on the companies. The last difference is the inclusion of non-financial areas. First, what does it emphasize? Firstly, operational auditing covers any aspect of efficiency and effectiveness in an organization work, while financial auditing it is limited to matters that directly affect the fairness of financial statements. Next, what is the scope in operational? It includes both financial and non-financial areas, while in financial auditing, it focuses on financial areas. Next is the depth of analysis. For operational auditing, it does in-depth analysis of non-financial areas, but for financial auditing, it does limited analysis of non-financial areas. The next point is about the reporting findings and recommendations in operational auditing. Reports that include findings and recommendations related to financial and non-financial areas, while for financial auditing, reports primarily focus on financial findings with limited discussion of non-financial areas. Lastly, stakeholder involvement. Operational auditing involves a wide range of stakeholders in contrast with financial audit, as it only involves a limited number of stakeholders.
Assalamualaikum and hi, my name is Nabila binti Muhammad Tamizi. Now I will continue with the difference between effectiveness and efficiency, which are both critical to operational performance. Effectiveness refers to how well we achieve our objective. For example, producing parts without any defects means we have accomplished our goal correctly. There is no compromise on quality or purpose. Efficiency, on the other hand, focuses on doing things in the best possible manner with the least waste of time and effort. So, using minimal resources to produce the same high-quality parts would be considered efficient. So, effectiveness is about the end result and efficiency is about the process. Next is common type of inefficiency and practical example of each. Recognizing this can help organization improve both cost management and performance. First, acquisitions of goods and services is too costly. This can happen if we skip proper buying processes. For instance, not requiring bid for purchases might lead to overspending. Second, raw material not available when needed. Delay due to poor inventory planning. For example, an assembly line being shut down due to material shortage. Third, duplications of effort by employee. This happens when multiple departments perform the same task unnecessarily. For example, if poor production and accounting maintain identical record. Fourth, work that serve no purpose. Sometimes, documents like vendor invoice or report are filed but never used. This wastes time and storage. And lastly, too many employees. If office work could be done by fewer people without affecting quality, then the current staffing is inefficient. This example highlights how inefficiency can silently productivity and increase costs. Next is relationship between operational auditing and internal control. Operational auditing and internal control are interconnected. Operational audits go beyond just number. They assess whether a company is achieving objectives effectively and efficiently, while also staying compliant with law and regulations. There are three key areas they focus on. First, reliability of financial reporting. Second, efficiency and effectiveness of operations. Third, compliance with applicable law and regulations. In this slide, we are looking at the strong link between operational auditing and internal control. These two areas work hand in hand to support three main goals of an organization. First, efficiency and effectiveness of operations. Operational auditing mainly focuses on this part. It checks how well the organization is running and whether resources are being used wisely to meet objectives. In short, it's all about improving performance. Second, reliability of financial reporting. This is about ensuring that the financial information reported by the company is accurate and compliant with approved accounting standards. Auditor help make sure everything is fairly presented. And lastly, compliance with applicable law and regulations. Company must follow law and rules. If they don't, they might face huge fines. Internal control help prevent this kind of legal issue.
Okay, thank you, previous presenter. I am Nur Shafika binti Muhammad Samri. Let's continue with type of operational audit, which had three sections, which is the first one is functional audits, and the second one is organizational audits, and the third one is special assignment. Basically, these three operational audits will performed by three groups, which is internal auditors, government auditors, and CPA firm. The first one is for functional audits, where international auditor will audit on a certain activities, business, department, subdivision of a business organization. This means of categorizing the activities such as billing function or production function. And the second one is function may be categorized and subdivided many different ways. For an example, the accounting function may be subdivided into cash disbursement, cash receipt, and payroll disbursement function. What is the payroll function? The payroll function is may be subdivided into hiring, timekeeping, and payroll reimbursement function. Thirdly, functional audits deal with one or more functions in an organization concerning. For example, the efficiency and effectiveness of the payroll function for a division for the company as a whole. Next is organizational audits. The first one is an operational audit of an organization deals with an entire organization unit such as a department, branch like a function, or subsidiary like a section. The second one is emphasize how efficiently and effectively function interact to coordinate activities are important in this type of audits. We want to check how efficiency, how good communication interact between those departments. Move on to special assignment is arise at the request of a management for a wide variety of audits, such as determining the cause of an ineffective IT system, investigating the possibility of fraud in a division, and making recommendation for reducing the cost of manufacturer product. In a simple way, that example, it might have suspect fraud in purchasing department, accounting department, so clearly special assignment done by internal auditor, not external auditor. Who perform operational audits? Operational audits performed by internal auditors. Internal auditor departments do both operational and financial auditing. The first one is they have an advantage in doing operational audits, and the head of internal audit department must report directly to audit committee. Audit committee is board of director and president or chairman non-executive independent director. The third one is internal audit department must have access to ongoing communication with audit committee of the board of director. For public listed company, it's compulsory to have internal audit department. The one who perform operational audit is their employee from internal audit department. For private company, it's not compulsory to have internal audit department. Next is government auditor, which is audit sector staff from Jabatan Audit Negara. It's different federal and state government auditor perform operational auditing, often as a part of doing financial audits. It have two, which is economy and efficiency audits. Also, it's called as performance audit to determine the first one is whether the entity is acquiring, protecting, and using the resources economically and efficiently. The second one is the causes of inefficiencies or uneconomical practices. The third one is whether the entity has complied with laws and regulation concerning matters of economy and efficiency. So for the program audit, it's called as audit government programs such as Bantuan Sara Hidup. The extent to which the desired result of benefit established by the legislature or other body are being achieved. The second one is the effectiveness of organizational programs, activities, or function. The third one is whether the entity has complied with laws and regulation applicable to the program. So to continue with, the first two objectives of each this type of performance audits are clearly operational in nature, while the final objectives concern compliance. To illustrate specific operational activities of a state governmental audit, the following three examples are taken from an article in the publication Internal Auditor. The first one is a separate hospital with its own administrative staff occupied three buildings on the grounds of another state hospital. Our audits show that the limited workload of the administrative activity of this separate hospital and its
proximity of the offices of the main hospital would permit consolidation of the administrative function of the two hospitals at a saving 145,000 a year. Second one is a local school district exercise control over 29 individual facilities. Our audit showed that the unused classroom facilities amounted to about 28%, or the equivalent of each school, and the enrollment was continuing to decline. We recommended consolidating and closing of individual facilities to extent possible. Such action would not only reduce costs but also provide greater flexibility in class size and course offerings. And the last one is the outstanding account receivable at a teaching hospital increased from $7 million to $11 million during during a two-year period. An audit showed that this serious situation was caused in part by a lack of aggressive follow-up action, insufficient supervision, and insufficient staff to keep up with an increasing workload. The next one is CPA firms. The first one is the audit consists of identifying operational problems and making recommendations. The background knowledge about client business, for example, suppose that the auditor determined that inventory turnover for a client lowered considerably during the year. The auditor should determine the cost of the slower turnover to evaluate the possibility of obsolete inventory that would misstate the financial statements. In determining the cost of the reduced inventory turnover, the auditor may identify operational costs such as ineffective inventory execution policies that can be brought to the attention of management. An auditor who has a broad business background and experience with similar business is more likely to be effective at providing clients and relevant operational recommendations than a person who lacks those qualities. The second one is engage a CPA firm to do auditing for one or more specific parts of its business. For example, a company can ask the CPA firm to evaluate efficiency and effectiveness of its computer system. And last but not least, engage with CPA firm only when the company does not have an internal audit staff, or if the internal audit staff lack expertise in a certain area. In some cases, management or the board of directors outsources the entire internal audit function to a CPA firm, or CO sources select internal audit activities such as IT operational auditing activities to done by jointly by a CPA firms and certain members of the company internal audit staff. In most cases, the CPA firm's management consulting staff perform this service. Notes that CPA firms cannot provide this service to their public company audit client. The two most important qualities for an operational auditor are independence. That's all from me, so I give to the next presenter.
Hello and Assalamualaikum. My name is Nordiana Wadika binti Dahari, and I will talk about operational auditors. So, let's talk about two essential qualities every operational auditor must have: independence and competence. So, independence means the auditor isn't part of the organization that they are auditing. This helps them stay neutral, no bias, no pressure to cover up problems. For example, let's say a retail chain hires an external CPA firm to look into its warehouse operations. Since the auditors are employees, they can give honest feedback, even if it's critical, without fear of upsetting their bosses. And secondly, competence is also important. Auditors need to actually understand what they are looking at. Imagine auditing a hospital. If you don't know how patient check-in or medication handling work, you will miss big issues. Competent auditor will know the right question to ask and where to look for red flags. Without that knowledge, even if you are independent, your audit won't be useful. So, in short, independence keeps the audit objective and competence ensure it is meaningful. Now, let's look at what we're actually evaluating in an operational audit. Focus is usually on two big things: effectiveness, which are this process or department meeting its goals, and efficiency, which are we achieving these goals without wasting time, money, or resources. So to measure this, we need something to compare against. That's what we call criteria. Think of a criteria like grading rubrics for a school assignment. If there is no clear standard, how do you know it's a good job or not? For example, if a delivery company promised 2-day shipping, but half of the package arrived in 4 days, we know that's not really effective. Or imagine a restaurant that can prepare 200 meals a day using 10 workers, but currently takes 12. That is also inefficient. They are getting the job done, but they are using more people and time than they should. So using clear criteria help us spot these gaps and improve them. In an audit, we don't just jump in, we have planning. Planning is a crucial part of any audit. You don't just walk in and start pointing out problems. Instead, you plan the audit and create smart, focused questions based on the area that you are reviewing. Let's say you are auditing a snack factory. Some questions might be, was the layout designed and approved by the professional engineers? Are machines being used to at least 60% of their capacity? Or does the setup allow materials to flow smoothly from storage to production? And of course, is the layout safe for workers? Are there any hazards? We have talked about using criteria, but where do these standards actually come from? There are 4 main sources auditors rely on. Firstly, historical performance. This is basically looking at how organizations did in the past. If last year a call center answered 90% of calls within 30 seconds, but this year dropped to 70%, that's a sign something has changed. Maybe technology, staffing, or customer volume. This historical data gives us a baseline to see if things are getting better or worse. Secondly, benchmarking. Here we compare the company to others in the same industry. For example, if most hospitals in the country that treat emergency patients within 10 minutes and your client takes 20, then you know there's a gap. You don't need to be exactly like others, but it gives you perspective on what is realistic. Thirdly, engineered standards. There are standards created by experts like time and motion studies. For instance, in a manufacturing plant, engineers may calculate that packing 100 boxes per hour is the ideal rate for one worker using a certain machine. If workers are only packing 60, that shows potential for improvement. These are technical, fact-based standards. And lastly but not least, discussion and agreement. Sometimes people in new or unique organization, there is no historical data or benchmarks. In those cases, auditors sit down with management to agree on what standards should be used. For example, a tech startup might not have years of performance history, so the audit team and managers agree on reasonable targets, like how fast customer tickets should be answered or how many bugs are acceptable per software release. In short, whether it's from the past, other companies, expert studies, or mutual agreement, having a clear criteria helps the audit make sense and drive improvement. So that's all from me. Thank you for listening.
Assalamualaikum, my name is Nurul Akmal Zafrina. So today I will present regarding phases in operational auditing. So operational auditing is a structured process with 3 important phases. So the first one we have is planning. So this is where the auditors get the information, sets objective, and determines how the audit will be carried out. Second, we have evidence accumulations and evaluation. So here, the auditor will collect and analyze data to assess how efficient and effective the organization operations are. Lastly, we have reporting and follow-up. So these phases, the auditor will report the finding to management and check whether the improvement are actually made or not. So in this case, each phases help to ensure that audit provide valuable feedback for decision making and not just a report to file away. So next, I will explain further regarding for each phases. So we will start with the first one, which is planning. Planning is a critical phase because it sets the foundation for the entire audit. So here's our 5 main things that are important in planning. The first one, we have scope of engagement, which is this define what will and will not be audited. For example, like, are we evaluating the HR department hiring process or just payroll management. Second, we have staffing. Staffing, we need to assign the right people with the right skill. For example, like a technical audit for factory machinery might require an auditor with an engineering background. So the third one, we have background informations. So we need to understand the company structure, policy, and processes. This will help us to identify which area have risk or improvement opportunities. So the fourth one we have is understanding internal control. So we need to check if the company has procedure in place to prevent error or fraud or not. So lastly, we have to decide on appropriate evidence. So we need to decide what kind of evidence we need for the operational audits. Will we review documents or interview employee or observe operation? This we must decide early. So for example, like if we are auditing a university IT lab, we will plan differently than if we are auditing a logistic warehouse. Each area has different risks, objectives, and standards. Then we will proceed to the next slide, which is evidence accumulations and evaluation. So this phase is where the real work happens. We gather and evaluate evidence. So here are four main things to conduct. The first one is documentation. We need to review SOP, perform a report, budget, and time blocks, for example. So second one, we have client inquiry. So we will ask the employees and manager questions about how tasks are done. The third one, we have analytical procedure, which is we compare performance data current year with last year efficiency or checking for unusual trends. If there is a biggest difference, we will need to search if there is any fraud or not. So lastly, we have observation. We will watch how processes are actually carried out to see if they match the procedure or not. So I will give example in a safety audit of elevator inspection. So we have documentation. We will look at the inspection schedule and report. Seconds, for the client inquiry, we will ask the inspectors about their process of the elevators. The third one, we have analytical procedure, which is we compare the number of overdue inspections across districts. So lastly, we have observation. We will watch an inspection in real times by our staff. So operational audit focus less on financial accuracy and more on whether the company is meeting the goal effectively and efficiently. So next, we move to the last phases, which is reporting and follow-ups. Once the evaluation is complete, the auditor will write a report and then follow-ups. Unlike the financial audit, operational audit reports are not shared with the public. They are intended for internal user only. So each report is customized based on what was audited. For example, like a report on the fleet efficiency will be different from one on a warehouse layout. So this report will include what was audited, what was found, and what should be improved. So then the auditor will need to follow up with the client. So follow-up is very important. For example, like after a few months, auditors check if the company has actually made the changes or not. If not, they will ask why and may suggest other solution to the client. For example, like if an audit suggested removing 2 unused delivery trucks, the auditor will return letter to see if those trucks were retired or resigned. Lastly, we will look through the example of operational audit finding. This example show how operational audit can lead to real improvement. So first, we will look at the first cases, which is janitorial firms. So by outsourcing janitorial services, the company saved $160,000, showing how outsourcing can reduce costs. However, the audit also found out that many janitorial tasks were not completed as required. This show that weaknesses in supervision. So we have another cases, which is only a few delivery trucks were actively used, meaning that the company was maintaining more vehicle than necessary. This is a clear sign that the company have underutilized resources. So the auditor also noted that some trucks were not suitable for their assigned jobs, emphasizing the importance of using the right tools for efficiency. Lastly, the use of computer programs will help to reduce manual work, saving time, and allowing staff to focus on important tasks. So, in conclusion, these findings highlight how operational audits help organizations to identify inefficiency and make smarter, more cost-effective decisions. So that's all from me. Thank you.